I am Erica Denicola-Shear from the Epilepsy Foundation of Northeastern New York. The time is 6 o'clock, which is our scheduled start time. But we are going to just wait one more minute or two to give a little more time for others to log on. So if everyone can just sit tight for another minute, and then I will make our introductions and we'll get rolling. Thank you all so much for being here.
Am I the only one here? Am I the only one here?
Nope, there are a few others here, Kenneth, and but we're just gonna give it just 30 more seconds, then we'll get started.
Because I'm in the view all mode and I only see you and William.
Yeah, others might not be having their video on, which is just fine. All right. All right, well, I think that we can go ahead and get started. So just 1 minute here. Okay, so to reintroduce myself, my name is Erica Denicola-Shear, and I am the Director of Community Education at the Epilepsy Foundation of Northeastern New York. And tonight's seminar or workshop is part of a series that we have put on this year to try to increase our community education efforts. So our other topics so far have been women with epilepsy, safety in patients with seizures, and another session about neurocognitive impacts on kids living with epilepsy. And tonight we will be talking about financial planning, special needs trusts, and special care life planning. And before we get started, I do just want to draw everyone's attention to that GoToWebinar control panel that you should be able to see. Because there is quite a bit of content we want to get to tonight, we are going to be utilizing that questions function. So if you look in your control panel, you'll see a bar labeled questions. And if you expand that with the arrow to the left, then you'll see a place where you can enter a question and submit it, and either I will respond to you directly, or there will be times when I can moderate those questions with Mr. Van Evera. So we'll be using that. I'm going to keep everyone muted for the duration of tonight's webinar. And without further ado, I'd like to introduce our speaker, William Van Evera, who is a special care planner with Charter Oak Financial. So his specialty is special care life planning, and I will let him go ahead and give you a little more info about that, and just take it away.
Thank you, and thank you everyone for joining us on this pandemic-related virtual meeting, which I'm sure most of you have gotten accustomed to over the past 6 or 7 months. I don't know that I'm still terribly comfortable with it, and I have to be honest and tell you that this is the first time I've done this presentation virtually, so should be interesting. But the reality is I've done it probably for the past 25 years, and so I think I know the material relatively well. A couple of ground rules. Erica mentioned questions. If you do have a question, you can, again, use that questions box as she mentioned. What I try to do with questions is we'll take probably a couple breaks during the program, maybe halfway through and then at the very end to deal with questions. I'd like to try to deal with questions in a group setting that can pertain to the majority of the people listening in. A lot of times we get questions that are really specifically related to the circumstances of the individual asking the question. And so when I get those kind of questions, if we were here in person, I would say, if you can come up after the meeting, we can spend a few times together and I'd be happy to address it. But of course, we can't do that tonight very well. So at the end of this meeting, everyone is going to be given the opportunity to request a follow-up conversation with me to discuss the particular circumstances of your situation. And then at that point in time, for those who would like to do so, we can get more specific about whatever questions you may have. So next slide, please. You can go to the next one. I got into doing this about 25 years ago. As you can see on the screen there, my wife and I are fortunate enough to have 3 children, the youngest of whom is Craig. Craig is now 32 years old, turned 32 this past summer, born with Down syndrome. We knew he was going to be born with Down syndrome before he was born. If I had to do it all over again, I shouldn't say I, if we had to do it all over again, we would have taken the same route, because it allowed us to, if nothing else, mentally prepare that we were going to be parents of a child with a disability, a lifelong disability. And I think it helped us kind of get ready, not in total, obviously, but for what the future might hold. Craig is as I mentioned, a 32-year-old man at this point in time. For the past 4 years, he has not resided in our home. He resides locally in a group home. He visits us on weekends, although he was with us for 6 months during the pandemic. We just felt that with the group homes basically in a state of shutdown, his quality of life at that point in time would be better spent with us, and I think he would agree with that. Though he's now been back at his residence for approximately 2.5 weeks and is doing quite well. Okay, we can move on, Erica. Okay, along the way tonight, I'm going to try to give you tips, ideas that I've come across both as a counselor to clients, and I guess I should also interject here that 95% of the work I do on a daily basis with clients is with clients such as yourselves. Parents who have children with developmental disability, a young adult with a developmental disability. Sometimes it's siblings who are ultimately going to be the caretaker for their brother or sister. And my first tip of the night is really, I think, best portrayed by this circular diagram on your screen. Because tonight we're going to talk about developing a life care plan for your child, for your young adult. And then this is an example, obviously, in my wife's case, in my case, our son is Craig. But I would tell you that if you try to do this by yourself, it's going to be a very, very awesome, overwhelming project. Now, it can be awesome and overwhelming anyway, but I always encourage people to try to develop a team of people that are going to be with you, sometimes for a short period of time, sometimes forever. And those people, outside of parents, could be siblings of the individual with a developmental disability. I have, my wife and I have 2 older children, a son who lives out of the area down in Georgia, and a daughter who lives roughly 2 miles from where I'm speaking from. So it's kind of a split type of arrangement here between our older son and our daughter. They do fight over the fact that one thinks they're going to be ultimately a better caregiver than the other. What they both don't know is they have no idea at some point in the future what they may be in for. And we'll talk more about that as we go. Many of my clients have other extended family that they can depend on. the other extended family want to get involved with the planning and be assistive in the plan. Depending on the age of your child, educators, teachers can be members of your plan. I should change the wording here. MSC, that's the old definition, Medicaid Service Coordinator. Now they're called care coordinators. For those of you whose beneficiaries are on the Medicaid waiver plan, you have one of those people typically at your disposal. Medical personnel can be part of the team, certainly. But most importantly, or as importantly perhaps, I've always said to people, I strongly encourage you to get a financial professional as well as a legal professional on your team. Because in this planning process, depending on how much of it you may have accomplished or done already, what you'll find is it's like a puzzle, a jigsaw puzzle with many different pieces. And if the pieces don't become coordinated and fit together the right way, sometimes in the haste to do planning, we wind up with a chaotic event, which doesn't really benefit anybody. So again, try to, round up some people that you think should be an integral part of your team, and don't try to do this alone. Okay, we can go next. Tonight, I'm going to try to, in the brief amount of time, and actually we have together, talk a little bit about certain elements of your planning. We're going to talk about estate planning and wills. We're going to focus on special needs trust. And towards the end of the presentation, we'll talk a little bit about letters of intent and guardianship. I must at this point issue a disclaimer so that I do not get in trouble with my firm. I am not an attorney, and obviously wills and trusts are legal documents prepared by an attorney. So I will be talking about these two things really in general terms. I can't draft documents. I do work closely from time to time with a handful of attorneys in the local area whose work I respect, and I know do good work in this type of planning. And we can talk more about that towards the end of the program. Guardianship is something that, depending on the age of your child, if he or she is under age 18, that's something you will have to make a decision about at the point in time they approach age 18. If your child is currently over age 18, maybe you've already made that decision, or maybe you were unaware of the fact that you probably should be thinking about the next step in terms of guardianship or the alternatives. Next. This is probably, in my opinion, the most important aspect of creating a plan. And that is simply that if any of you ultimately we end up working together, one of the things that any planner wants to know is, okay, you're creating a plan, you're creating a lifelong plan for your son or daughter. Once this plan is created, what are the goals of your plan? What are you hoping it will accomplish? And that's a hard question to answer. And depending on the age of your child, it may be doubly difficult. People like myself, attorneys, when we work with folks like you, ultimately are able, most of the time, to help provide the structures to the plan that hopefully will assist you and your child in attaining the goals that you've set out to attain. Normally, I would say if we were together, how many of you have been on a vacation recently? Well, that answer tonight is probably zero, unless it was a stay vacation, which most of us have gone through for 6 months. But again, it would be like walking into a travel agency and saying to the person who waits on you, "Hi, I'm here. I'd like to talk about going on vacation." And the representative in the travel agency might ask, "That's terrific. Where would you like to go?" And your response is, "I have no idea." Well, they're going to be pretty hard pressed to give you any guidance in terms of what type of places, be they local, be they in the United States, be they in some place around the world, that you might consider going to. So again, goals and structure are going to be two very, very key components of whatever plan that you folks end up comprising. Next. And understanding also that, and I get this a lot, when is the best time to start planning? And my answer is always the same: yesterday. So if you didn't start yesterday, then today would be a real good day. And the reason that is because none of us are immortal. Someday, none of us will be here. And hopefully for most of you, that will be a long time from now. For me, I'm hoping it's a long time from now as well. But I know that someday I won't be here. My wife won't be here. And then it will be up to the folks who are team members to execute Craig's plan so that his life carries on to the degree we had hoped it would. So again, if there's another tip I can give you, don't procrastinate. Human beings are great procrastinators. There's always going to be a better day. There's always going to be a better time. So let's hope that, you know, we can get this thing off the ground if you haven't already started. Next. These are photos of my family. The upper left-hand corner is Craig several years ago, myself and my older son. Craig likes going to Yankee games. We didn't get to any this year, obviously. He likes mini golf. He likes going on family outings. Birthdays are second only to Christmas in Craig's life. And it doesn't matter whose birthday it is. His birthday is always top shelf, but he likes celebrating everybody's birthday. That's my beautiful wife, Terry. This past spring, we celebrated our 40th wedding anniversary. And it's been a journey. Like most folks who are married, you know, marriage is a journey. We certainly have had an interesting one. All of our children are a little bit different. My son is a self-employed deli operator in the town of Beaufort, Georgia. My daughter is a school psychologist locally in a city school district, and Craig is Craig. Just a pleasure to be around, full of vim and vigor. Next. Oh, wait a minute, before you leave that, if you can go back. Again, the second reason I show these photographs is because when my wife and I started developing and talking about Craig's plan, and we started his planning probably when he was around 8 or 9 years of age. And one of the things that came to mind just in general terms was, you know, what does Craig enjoy doing? What does he like to do now? Well, now he's 32 and he likes some things that he didn't know existed when he was 9 or 10. But our planning has remained the same. It's been tweaked over the years, and I'm sure it will be tweaked more going into the future. But one of our goals was we want his plan to be able to enable him to enjoy the things in life that he's been able to enjoy with us. And generally that's going to involve funds, which we're going to talk more about in a few minutes. So that was very prominent in our thinking. Now you can move to the next one, Erica. And this is my daughter holding our granddaughter, and my Craig in the middle, and then that picture on the right was taken about, I'm going to say 8 or 9 years ago at the Down Syndrome Aim High Buddy Walk, which we are fond of. Okay. All right, so as we get into this, you know, what I'm calling special care life planning, really what is it? In my viewpoint, it's acting responsibly, beginning to create a plan to protect our children's future, to protect their government benefits if they are receiving or will ultimately receive Medicaid benefits or SSI. And by doing so, will give us, the parents or the caregivers, one more level of peace of mind. I had mentioned just a few seconds ago that, you know, none of us are immortal. All of it, there's an end point to all of our lives. But when my wife and I go to bed at night now, while we certainly are concerned about Craig and some of the daily things that he's doing, we know that his plan at this point in time is pretty well put together, and that the pieces are all there, and it will proceed without us because we've taken the time to plan. So again, that's what I try to help people accomplish. Next. So what can you do to make sure your child is taken care of? Next. Okay, we're going to start with just the overall concept of estate planning here. And again, I point out again, I'm not an attorney, but this is fairly generalized information. Most of you, I'm sure, undoubtedly have heard the term of a will. And if we were doing this in front of one another, I would never ask you to, as a show of hands, to say, how many of you have wills? I think that's none of my business, quite honestly. But I will tell you that it's a planning tool, and it's probably a tool that's the most overlooked tool by people, particularly those with planning the future of a child with a disability. Because what they do, in the layman's terms, it's a statement of my intentions, your intentions, in terms of, as my attorney friends would say, who gets your stuff when you die? And why are they so important? Because not only do they outline who you want to get your stuff when you die, but they should also outline who, when are they going to come into this stuff, and in what form will they get the stuff? I generally ask the question in a group setting, and you're probably all glad that this is virtual and not in person, because I tend to, my former school teacher's hat goes on and I pick on people to answer questions. But I would say, give me your definition of a will. And most of the time, people's answer are much like I just phrased a little bit ago. You know, well, they say what, you know, who I'm going to leave my stuff to when I die. And that's true. However, sometimes what people don't know is that wills, in terms of who gets your stuff, the only stuff that a will directs is property that is owned by an individual, individually. Said a different way, I'm sure many of you own a home jointly with someone else. In my case, it's my spouse. She wouldn't have had it any other way. Most couples, not all, but most couples have joint bank accounts. You may own property with a sibling. So a will does not direct or control jointly held property. So as an example, in my will, if I were to leave one half of my house when I die to Erica, she will be disappointed when I die, because the deed on my house says it goes to my spouse. Our joint bank account will go to my spouse. It won't go to the Epilepsy Foundation. The other type of property that a will does not control is any type of property that will go to someone else by virtue of a beneficiary designation, such as life insurance, retirement plans, IRAs, 401ks, 403bs, etc., which most people have, either through their employment, or if you're self-employed, you've created one on your own. Those don't pass by will either. So my wife and I have recently updated our wills, and it came to pass that we really individually have hardly any property. It's either jointly, or it's going to flow to one of us, or ultimately our older children via beneficiary designation. But herein lies the potential problem. Let's suppose, I'm going to assume that many of you listening tonight have some amount of life insurance in force on your life, be it through your employer, or you purchased it on your own, or maybe some of each. Very often when I meet with people, I ask them to, get their insurance policies together so we can look at it, retirement plan statements. And one of the first questions I ask is, who's your beneficiary? And the most common answer is, well, I think it's ... You got to know who it is. And here's why. In a few minutes, we're going to talk about using certain tools to help ultimately give your disabled child, upon your death, property that they can benefit from. But if we're going to protect their government benefits, typically SSI and or Medicaid, we don't want to leave any property outright to the individual. And that's where supplemental and special needs trusts will come in, and we're going to talk about that here shortly. So ultimately, when I get together with people, and even when ultimately attorneys get involved, one of the first things we look at is, do your beneficiary designations match what your plan is trying to do? Do your bank accounts match, or investment accounts match what your plan is trying to do? And because if they don't, most of your plan could be terrific, but that one little glitch causes a problem. And we'll come back. I'm going to give you a couple of examples of this here in a little bit, but you should have a will, everyone, regardless of how wealthy, quote unquote, you think you may or may not be, because it's a statement of your intentions. If you go to, when you go to an attorney, if you've gone to an attorney to have a will created, most attorneys also will want you to execute the other two legs of what I call the three-legged estate planning tool, and that's executing a power of attorney, whereby you would appoint an agent to act on your behalf relative to financial matters if you weren't able to, and a healthcare proxy, which basically dictates the same thing, only with healthcare decisions. Three very important documents that every one of us should have, regardless of whether we're in our 20s, our 30s, our 40s, 50s, or beyond. These are just good, solid planning arrangements. Okay, Erica, we can move on. Talked about this a little bit. Individually held property is controlled by will. Jointly held is not controlled by the will. Beneficiary designated property is not controlled by your will. And what if you haven't executed a will? Most states, New York State being no exception, quote unquote, writes one for you under what they call the laws of intestacy, which basically say if you pass away without having executed a will, and you are married with a surviving spouse, 50% of your individually held property will go to your surviving spouse, and 50% will go to will be equally split amongst your children. So if one of those children, in my case, one of those three children is a child with a developmental disability, is that a good thing? Do we want that child to come into that property and give it to he or she outright? Well, I think you're going to see here in a few minutes that no, we don't want to do that. Next. Okay, we're about to kind of get into the whole concept of trust, which is a different legal tool. I'm going to just pause here briefly to see if people want to start putting down in the box there some questions relative to the first few minutes of what we talked about so far. So I'll give you a chance to do that while I quench my thirst here.
There was one question asking for clarification on what is a letter of intent.
Yeah, we're going to get to that at the end.
Yeah. But other than that, there aren't any other questions at this time. But if anyone has a question, do feel free to enter it now.
Okay. I created this diagram, and I'm not an artist, but I think it kind of is a very, very simplistic schematic of how a trust works. And first of all, what is a trust? Well, first and foremost, it's a legal document created by an attorney. But first, it needs a creator. So in the case of a trust for a child with a disability, typically a supplemental needs trust, which we'll talk specifically about here in a second, someone has to create it. The attorney's synonym for that is grantor. I think creator explains it a little better. So a creator creates a trust. The trust is the legal document which specifies what the trust is about. What are the objectives of the trust? Another component of a trust is a trustee. It's an individual, it's a corporation, it's a combination of the two that you would appoint to manage the stuff that's in the trust. Now, over the years, people have mistakenly thought about trust as being only for very wealthy individuals, excuse me. And really nothing can be further from the truth. So for example, I'll go back to life insurance just for a second. For those of you who are married with children and own life insurance, I bet if I were to look at your life insurance policy, regardless of the carrier company that you're with, I probably would see that the primary beneficiary of your life insurance is your spouse, and your secondary or contingent beneficiary, and you should have both a primary and a contingent, in my opinion, is probably your children equally. But let's talk about a family that doesn't have a child with a disability here for a second. So that was my case until 1988, when Craig was born. And my beneficiary designation up until probably 2 years prior to 1988 was exactly as I just spoke of. But then I realized, wait a second, if I were to die back then, I would have been 38 years old. My daughter would have been 6 years old. And my older son would have been 17. Yeah, there's a spacing between my oldest and my daughter. Good planning, bad planning on my wife and I part, but hey, not everything always works out according to Hoyle. All right. But in New York State, a beneficiary cannot come into property through a beneficiary designation and own it outright until they're 18 years of age. So what most attorneys would recommend in that case is make it, and if that's would be the desire of the folks with the life insurance, yeah, I want my spouse to get it first, but if he or she predeceases me, I certainly would want it to go to my children. So most attorneys will recommend what's called a management trust. And that trust would act as the secondary beneficiary designation. The beneficiaries of that type of trust would be in my case, my older son and my daughter. And within the trust, my wife and I could control what they're going to benefit from. At what point in time might we give it, could the trustee give it to all of them outright, which is also nice. As I tell my kids all the time, don't forget I control my money even from the grave. So be nice to dad and mom, which they are. You are only beneficiaries of this trust. You don't own the stuff that's in the trust until the trust says you can become the owner. So that's basically the schematics of just a plain vanilla trust arrangement. Okay, we can move on here, Erica. Okay, I'm sure most of you are taking notes tonight. Couple of numbers you need, and one number needs to be adjusted, obviously. Under Medicaid, it says $14,850. It's no longer that figure, it's now $15,000. SSI is still $2,000. What those numbers represent, and we're talking about ultimately protecting an individual who has a disability, their government benefits. These are the two most typical government benefits that individuals with disabilities, developmental disabilities, have at their disposal. They are needs-based, which is why the government imposes ceilings on the amount of assets an individual can have in their own name and still be eligible for benefits. My son started receiving SSI benefits when he was 18 years of age, and we'll talk about that a little bit more here in a second. Based on his financial circumstances, not the circumstances of mom and dad. And that's what gave rise to the Medicaid waiver program, which still is in place today for many people. By the same token, when my wife and I ultimately took our Social Security retirement, my wife is fully retired. I'm still working because I love what I do, but I am taking my Social Security retirement benefits. All of my son's money, Craig's money then, is not in SSI form. It's in, Craig gets a percentage of my Social Security retirement benefit. So it will change over time. But most importantly are these two numbers, 15,000 for Medicaid, 2,000 for SSI. Okay, we can go on. A special needs trust is, not to be redundant, special, because it's really designed 90% of the time by parents who have a child or children with developmental disabilities. The children are going to be eligible for government benefits, or perhaps they're already receiving government benefits. And the special needs trust is designed to create a legal way of leaving that child with a disability or children with a disability property without impacting their benefit eligibility. The second critical issue with a special needs trust is the selection of a trustee. And if you think about a trust, and I'll go back to the kind I mentioned at first, talking about younger children being life insurance beneficiaries when they're not even of legal age to do so. They couldn't come into the own the property anyway. Those types of trusts typically have a lifespan. Child might be 10 or 11, 12 years old now. In 12 years down the road, he or she might be 24, 25. Maybe at 30, as my attorney buddies sometimes say, they're going to be who they are at 30. And so maybe you just let them own property outright at that point in time and the trust terminates. Special needs trust, on the other hand, is lifelong to the beneficiary. Craig is 32. He might live till he's in his 70s. That's 40 years. I think I'm in really good health. I don't think I'm living 40 more years. So the selection of a trustee for this type of trust is important. I'm a big believer in co-trustees. A person who has a knowledge of the individual with a disability. In our case, it's our daughter right now, which really annoys my older son in Georgia. But the reason it's my daughter is there's 17 years between Craig and his older brother. And while there's 6 between my daughter and Craig grew up with his sister. He really didn't grow up with his older brother. He loves him dearly. We go to visit, not lately, but we go to visit frequently. But my son is not in a position to, he doesn't live locally. He doesn't really understand all the nuances of planning and Medicaid and Medicare and all that stuff. So he's important. He would take over responsibilities in a heartbeat, excuse me. But right now it's our daughter as co-trustee with a local bank. And the reason I'm a big proponent of a co-trustee, one of them being a corporate trustee, a trust company or a bank, is because there are financial issues that have to be dealt with by the trustee. One of the things the trustee has in a special needs trust is total discretion over saying yes or no to expenditures. So if my wife and I were no longer alive and Craig's trust was in effect, my daughter, as his legal guardian, and more on guardianship later, would maybe go to the trustee and say, hey, Craig's TV is past its prime, he needs another one. Otherwise, he doesn't have one. Or Craig would really benefit from going to this summer camp. Or Craig would really like to go to Georgia to visit his brother and sister-in-law and nephew. So the trustee's job is to write the check to the provider of the service, never writes a check, in my case, to Craig, because that could, in essence, screw up his eligibility for benefits. So a trustee selection is important. Third check mark here is communication with your family, meaning particularly extended family. And what I mean by that is, whether you have a small family or a large extended family, one of the key questions that you will need to ask, or I suggest that you ask members of your extended family, is simply this. As part of your planning, so let's pretend that Erica is my sister. I would have to ask Erica whether or not, as part of her planning, she is intending to leave any type of property, asset, cash to Craig. And before the person answers, my take was always to continue with, and oh, by the way, whether you answer yes or whether you answer no doesn't impact my feelings towards you, but it may impact planning, because if you are intending to leave Craig something, then there's a set of instructions I need to give you so that it's left in a way that meshes with the planning Carrie, my wife, and I have done. So that communication is critical. It also can be extremely awkward. And over the years, the past 25 years of doing this work, what I have found is it's always the least likely person in your extended family, the person you would never expect necessarily to leave something to your child, excuse me, that does. And that's the person who can, not intentionally, throw a monkey wrench in the works. So communication with extended families is important. Last but not least, and this should probably be first, please seek out an experienced attorney. And I don't mean they've practiced law for a long time. I mean that they are deeply involved in this type of planning, because it's a specialized field. And ultimately, should any of you follow up with me and we develop some type of working relationship, I am able, if you would like, to provide you the names of a handful of attorneys that I've worked with over the years in our local area, that if you went to any one of them, I know the work would be done properly. It's certainly not an all-inclusive list, but it's a familiar list. It's people I'm familiar with, people that I have joint clients with, and over the years have proven that this is an area of the law that they specialize in. So, okay, we can go to the next slide. The one thing that wasn't in that little schematic I composed or drew up for the how does a trust work, which is really the major component, because without this, there's no need for a trust, is how is the trust going to be funded? Now, we're going to spend a fair amount of time on this in the next segment here. You want to leave something to your son or daughter with a disability. Where is it going to come from? What's the best type of property to leave? And there really is no best property, but we're going to delve into that a little bit. Over the years, I've run into countless people who have said to me, I really don't need your help. I know you're really good at this, but we have a special needs trust, so we're all set. And I'll say to them, that's great. If I could ask you one question, my question would be, how are you going to fund the trust? And 7 out of 10 people respond this way. What do you mean? See, it's not just the legal document that's important, because the trustee has to have ultimately something to manage for the beneficiary. And where's that going to come from? Okay, next. Okay, and here, Erica, let's go to this supplemental needs SNT funding program. So here we are. We've decided that looking into this supplemental needs trust, SNT, is a really good idea, perhaps. I talked earlier about this planning and what are the goals and objectives of your plan. I said just at the outset that initially one of our goals was to make sure there was enough funds after we were not here, my wife and I, that Craig could still enjoy the things he likes to do without being a financial burden to his brother or sister. That was very critical. That was a very, very big, important goal of our plan. So how much is going to be needed? Well, I can tell you that since the time my wife and I did our planning, initially back when Craig was 8 or 9 years old, we've changed the amount a couple times. So let's move on to the next slide. I wish I could see all of you who are here tonight, because this is one of my favorite parts of the program, where I ask everyone the question. And the question is there on the slide: how many of you have $100,000 to $200,000 laying around? You don't know what to do with it, and you'll never need to use that for yourself. I wish I could see if there was any hands going up, but I doubt there is. It certainly wasn't true in our case. And yet, 100,000, 200,000, ultimately in a supplemental needs trust, will that be a sufficient amount of money to carry out your plan? Don't know. That's up to you. What do you want your plan to do? But what has become pretty apparent over the years is that, I know that there is someone out there that would answer, yeah, I have that much money laying around, maybe even a little more. I'm never going to need it. I haven't had the good fortune to meet that person yet. If any of you know someone like that, I wouldn't mind being introduced to them. But that's just not the way most situations are. Next. Craig is our son, and we want the best for him, the best to the extent that we're able to provide for him. We don't want, he will become, ultimately, when my wife and I are no longer around, a time burden, perhaps, to his sister and brother. They will have to devote time to him more so than they do now, because mom and dad aren't there anymore. But we don't want Craig to become a financial burden to his brother and sister. That was also huge in our planning. Next. So here's a schematic, and this is slightly out of date, but not by much, okay? Right now, Craig gets only SSDI, Social Security Disability Income. That's because my wife and I are both collecting our Social Security retirements. So they direct deposit in Craig's joint account with us, $1,256 a month. I mentioned he lives in a group home community residence, which he pays, it's now $1,014 a month. So therefore, he has about $242 a month left over, personal allowance, to cover everything except food and shelter, recreation, personal grooming, dinners out, movies, if they ever reopen, books, CDs, and he really knows how to buy books and CDs, theater tickets, which are not a big hot item right at the moment, clothing, travel, cable TV, internet, and the list goes on and on and on. Not a lot of money, $242 a month to potentially cover all those things. I tell the story that Craig has, from a very young age, became enthralled with initially anything Disney, DVDs, movies. And I think when he was 9 years old, approximately, we took him to New York City on Broadway to see The Lion King, which we now have seen as a stage show. I've lost track, at least 4 or 5 times. He's been to see numerous shows at Proctor's. He loves going to the theater. Now, the thing is, he can't go by himself. He has to have someone go with him. So when one of his house staff goes with him, Craig has to pay for 2 tickets. When the day comes that mom and dad aren't here, and he wants to get on an airplane and go to Georgia to visit his brother and sister-in-law and nephew, he's going to need 2 tickets. And I'm pausing there so that can sink in a little bit with you, the audience. Next. So basically, and this is a very simplistic way of presenting this. So let's assume your supplemental needs, special needs trust ultimately gets funded with $100,000. We're not going to worry about where that comes from just yet. And let's assume that your trustee can invest that money, and I use the term invest in quotation marks, and get a rate of return at 5%. The goal of the money in the supplemental needs trust, the principle, if you will, is to provide additional income that could be used to pay for special or supplemental needs. So in this example, if $100,000 could get 5% rate of return, that investment would result in an additional $5,000 a year in income that could be used. And that's before taxes, because trusts are a separate taxpayer with their own tax ID number. And yes, a trust has to file a yearly tax return just like the rest of us do. But in this example, that extra $5,000 a year on a gross basis would provide an additional $416 a month to provide for supplemental needs. And the question then becomes, would $416 a month be able to provide all of the supplemental needs for your son or daughter that would accomplish the goals you set out as part of your plan? Maybe it would, maybe it wouldn't. That's something that when I work with clients, we try to help them determine, what's the number? What's the right number? Okay, we can go to the next one. A supplemental needs trust can be used pretty much to provide anything except a benefit that government benefits, SSI, Medicaid, are already providing. As in my son's case, Medicaid is providing the roof over his head and the food on his plate. But everything else, recreational, educational, vacations, travel, unpaid medical expenses, clothing, it's up to him. I'm sure that most of you are probably by this time familiar with something, an OPWDD creation called self-direction. I'm not going to spend a lot of time on it tonight, but self-direction is a program that's about 5 years old now. And it was OPWDD's mission to encourage people, folks with disabilities and their caretakers, to investigate and move away from the standard Medicaid procedures and go self-direction. Self-direction is really a partnership between the disabled person, the disabled person's care team, and Medicaid, whereby Medicaid will provide funds for the plan. The question is whether the funds will be sufficient enough to carry out the plan. What I haven't told you about Craig is he's 32 years of age. I've told you that, but he functioned most of the time as an 8 or 9-year-old. He will need supervision the rest of his life to some extent. He really, and we have investigated self-direction, and the amount of money his services and deemed needy by OPWDD would provide, the budget amount of money that they would provide to him is insufficient to do what he wants to do or would need to do. So for us at the moment, unless things change drastically, self-direction doesn't work for him. I know other people who it works great, but I would say that that's the minority, not the majority of the people that I've come into contact. Okay, let's go to the next slide if we can. So back to how much money am I going to need? What I've found over the past 25 years is there are predominantly 4 methods of funding a supplemental needs trust that people use. And in no particular order, the first is extended family. I talked a little bit about extended family earlier. But many times, if I were in a group setting now and you guys were all sitting in front of me, I would say to you, what do you think the answer is when I sit down with a new client couple and talk about this? And I ask them, are you expecting any member of your extended family, not you guys, but your extended family, grandparents, your parents, aunts and uncles, etc., to leave anything to your child? And then my question to you all would be, what do you think the response rate is? And most of you are probably saying to yourself, it's probably no, just the opposite. I would say 60% of the time, people say, yeah, I think we are expecting some. And that's great. My next follow-up question is, how much are you expecting? And what do you think their response is? Their response is, I don't know. I'm not sure. I know my parents have mentioned something, but they never were ones to talk to me about money. So I don't know. I have a client, young woman who I met 10 years ago with 2 children with disabilities. And it took us 3 years, more her than I, but to get her parents, the children's grandparents, to tell her how much they had set aside. They had created a supplemental needs trust for these 2 grandchildren, but wouldn't tell the mother. And they get along fine, but they just wouldn't discuss the money aspect of it with her. So it was like pulling teeth to try to get the answer. So the question is, even if you're expecting some contribution from extended family, how much will it be? Will you ever know? So it's kind of difficult to plan around that particular method. Not that you won't accept it, but if you don't know how much it might ultimately be, it makes it hard. Next. As we all go through life, we accumulate things, we accumulate stuff, and that stuff and things constitutes what's known as our estate. Our estate is the sum total of all the stuff we own, be it individually or jointly, during our lifetime and at our death. So what's in our estate? Well, value of our home, value of our retirement plan, savings, maybe we have vacation home or other investment real estate, our personal effects. Some folks are into collectibles, life insurance, death benefits make up part of our estate. And this is not an all exhaustive list, but a pretty common list. So when our days are finally done, somebody is going to have to do an accounting to determine what was the value of our estate. And in our will, we have decided, and through beneficiary designations perhaps, who we want to get our stuff. Next. The second method, and that's why I did the preceding slide before this, is this is my term. And it's really what most people, the method most people use by default. I call it the what's left method. And it's here where I have to tell you a quick true story. About 10 years ago, I met a new client at not a virtual meeting, but one of the in-person meetings that I do a lot of. And he indicated a desire to get together for subsequent meetings and follow-up, which we did. So the first time I met with him in his home, he and his wife in their home, he was a very engineering, analytical type of personality, and he had all his stuff neatly piled on his dining room table. And after, some pleasantries, we sat down and he said, I've gathered all my stuff. What would you like me, what do you want to look at? So I just said, I don't know, toss me something. So he did, literally. So he tossed me his will. And his will, again, not being an attorney, but having some degree of familiarity with wills, I've looked at hundreds over the years. He said, upon my death, I leave everything to my surviving spouse. This gentleman had 3 children, just like I do, by the way. In the event I die without a surviving spouse, I would like my estate divided into thirds. I will leave 1/3 to son A, 1/3 to daughter A, and 1/3 to son B, who, by the way, was severely autistic. And in his will, he and his wife had also created a supplemental needs trust. So he wasn't leaving anything outright to the younger son with autism. He was leaving it to the trust. So I scanned through all this and I handed him back his will and I said, thanks. Throw me something else. He said, well, wait a minute. How did I do? I said, what do you mean? Well, how did I do? My plan so far? I said, I don't know. And he got kind of irritated, actually. And he said, well, how come? I had you come he lived in Glens Falls. And so I had you come all the way up here. How come you don't know? So I said, I'll tell you what. His name was John. I said, John, I'll answer your question if you answer mine first. He said, go ahead. What's your question? I said, when are you going to die? He said, what do you mean? I said, okay, do you have like a date? Do we know, when you're going to pass away? I said, and before you answer, the reason I'm asking you that question, if you tell me it's this afternoon you're going to die, then I can tell you how you did. But I don't think you're going to tell me that. You're going to tell me, I don't know. How will I know that? And you'd be perfectly valid in your response. So if you tell me, you're 48, 49 years old now, and you're hoping to live until you're 90, which is 40 more years down the road, I don't know how much of your estate you're going to consume. I don't know how much you will have needed during your own retirement years. I don't know if you and or your wife will contract a long-term health care need and possibly need home health care or nursing home care. So I don't know, because your will just says you're going to give the supplemental needs trust 1/3. 1/3 of what? This afternoon, I know how much 1/3 would be. 10, 15, 20 years from now, I have no idea. So I was about ready to pick up my stuff, because my things, because I anticipated he was going to throw me out of the house. And there was a fairly long pause, and we all have been in situations where, my God, a minute of silence can seem like an hour. But he finally said to me, well, what you're telling me is, with all the planning that so far we've done, I haven't guaranteed nickel one to my son's trust. I said, well, you said that, I didn't, but yes, I agree. Well, over the past 10 years, we've had a fine, lovely working relationship. He's one of my best friends, and we helped him create funds that will automatically provide some sort of guaranteed money. And then if there's any residual value of his estate left when he passed, or his wife passed away, that's also been proportioned to his son's trust. So we help him fix it. Okay, next. Some people ask, well, can I just start saving money if I create a trust and periodic in money, and I can set up a monthly, savings plan where I put X amount of money into the trust every month? Well, the answer to that question is yes and no. The answer is no if your child is under the age of 18 presently, because the law says he or she is a minor, and your duty as a parent to provide for he or she anyway. So you're not allowed to fund a supplemental needs trust with your own money, cash today, if your child is under 18. If your child is over 18, yes, you can. But then the question becomes, if we discount people putting money into their retirement plan through work, their IRA, their 401k, their 403b, what's the savings rate in this country? It's improved a little bit during the pandemic, I will tell you that, but it's still somewhere around 3 or 4% of their income, net income. And sometimes that savings is not regular, it's sporadic. And I put the money in an account, but then I need it and I take it out. So this is not a method that typically works well for a lot of people. Okay, next. So what about life insurance? Two words that are dreaded by most people. Life insurance. Well, think about it. Life insurance is a product that guarantees a specific amount of money when someone passes away. The beneficiary designates who that money is to go to when the insured individual passes away. It's a budgetable expense. It could provide guaranteed supplemental need trust funding if the beneficiary designation on the policy was payable to the individual's SNT. Those of you who own life insurance and are paying for it individually, you own it yourself, are paying a premium. But those premiums, if you think about it, are pennies on the dollar. And what do I mean? What do I mean by that? Let's say you own a $100,000 policy and the premium is $1,000 a year, just making this up. Well, the premium is 1%. 1,000 is 1% of $100,000, the $100,000 death benefit. That's where the term premium comes from. There are many different policy designs these days that can be kind of factored in to provide funding for a supplemental needs trust. And one of the things that can allow, as couples reach their retirement years, is allow for more spending in a good way for the couple during retirement. They don't have to skimp and save. One of the saddest phrases I always hear, particularly from people who are either very near retirement or in retirement or approaching retirement, is, nobody calls me William, by the way, they call me Bill. Bill, we have a dilemma. And I'll ask, and the dilemma is, well, we'd like to have a nice retirement, but we also want to leave something for Joey or Mary or their child with a disability. And we see those two things as being mutually exclusive. I don't know how we can have a nice retirement if we have to scrimp and save to leave money for Joey or Mary. And if we leave Joey or Mary something, then what are we going to do? It's a real dilemma for most people. So life insurance in many ways becomes an excellent vehicle, not the only vehicle necessarily, but an excellent vehicle at a discounted rate, on pennies on the dollar, to help people provide some, in some cases all, of the guaranteed funding for their trust. Okay, next. I want to spend a very few minutes on ABLE accounts. You may have heard of this, maybe you have, maybe you haven't. ABLE accounts actually were enacted during the Barack Obama administration and came into federal law December of 2014. But one of the provisions of the act was the federal government said to the states, okay, we're allowing this, you guys to do this. You guys figure out in each of your states how you want this to work. And it took New York State, no surprise, 5 years to figure it out. They didn't come out with the specifications until last year. Okay, we can go to the next slide. But what the ABLE account, many people have asked me, well, is an ABLE account the same as a supplemental needs trust? The answer to that question is yes and no. So to be able to have an ABLE account, the account holder, which is the person with the disability, by the way, must be eligible for SSI or SSDI, Social Security Disability Insurance or Supplemental Security Income. They need to file a certification of disability with the IRS because they, the disabled person, owns the account. The contribution limit is raised. It's now currently $15,000 a year, but only the first $100,000 of account value will enjoy preferred tax status, meaning there's no tax on the growth of the money, and if the money ultimately is spent on legitimate expenses, much like expenses out of a supplemental needs trust for the disabled person, they're not taxed as income. Anybody can contribute to an ABLE account. So if we had an ABLE account for Craig, we don't, but if we did, my wife and I could contribute, his brother and sister could contribute, aunts and uncles could contribute, anybody who wanted to, but there can only be one account per disabled person. One of the drawbacks of an ABLE account is it comes with a Medicaid payback option, or not really an option, a demand, which simply says at the end of the disabled person's life, whatever value is left in their ABLE account, and there doesn't have to be anything left, but should there be anything left, Medicaid has the right to demand payback for the services they provided that person during their lifetime, which is really a negative in my estimation. So I can tell you that since 2014, or actually more accurately since early 2019 up to the present day, I have not helped a person open an ABLE account. I just think, in my opinion, special needs, supplemental needs trust are the better way to go. Okay, next. So which method of funding your trust works going to be best for you? Extended family contributions, the what's left method of consuming most of my estate during my lifetime. If I don't consume it, what type of retirement lifestyle will we have? Will we be satisfied if our child's trust only receive what's left? Or do we want to guarantee something? Next. So again, the choice is to plan now or leave it up to chance. Erica, we can go back to the original presentation and go back a couple of slides. Okay. All right, stop right there. Couple more things well, actually, yeah, that's okay. Couple things you need to know about supplemental needs trusts. Number one, there's two points in time that a supplemental needs trust can become operational. And they are right now, today, tomorrow, or when one passes away. If a trust becomes operational currently, it's called a living trust. The grantor, creator creates it, and it goes into operation right away during the creator's lifetime. On the other hand, if the trust is all set up within the creator's will, only to become operational when the creator or grantor passes away, then the lawyers refer to that as a testamentary trust, meaning it's all ready to go, but it's not operational. So should your trust be a living trust or a testamentary trust? Well, in my opinion, that depends on how the trust is going to be funded. And one of my very staunchest recommendations to people is, I don't recommend funding your child's supplemental needs trust with any of your assets before death. Why? You might need them. So again, I'm going to tell you another quick story, true story. Met a woman who came to one of my programs. She was in her 60s, had about a 30-year-old son, as I recall, with a disability. So during our follow-up session, she said to me, I asked her what was best about the program, and she says, I really enjoyed hearing about supplemental needs trust. And in fact, it's going to create some action for me. I have an action plan. I said, oh, good. What is it? She said, well, I'm not very wealthy, but I do have about $100,000 down at my bank that I want to go to an attorney, have the trust created, and then I'm going to put that $100,000 in the trust. And I asked her name was Donna. I said, Donna, what other monies do you have? Well, that's it. I don't have anything else. So I said to her, okay, let me ask you a question. You're in your 60s, I think she was 61 or 62 at the time. Would there be any chance in the next 5, 10, 15, 20, 25 years, you might need some of that money for yourself? Oh yeah, she said, absolutely. Why can't I get it out? No. Because when a supplemental needs trust becomes operational, it also becomes irrevocable, meaning that any funding or property that goes into the trust can only come out for the benefit of the disabled beneficiary. And I tongue-in-cheek sometimes at my in-person programs say, so if you're putting in 10 or 20 grand and then you mistakenly say, oh geez, we needed that to remodel our kitchen, not that that would remodel a kitchen necessarily today, but oh well, your trust is irrevocable. So that's why I never encourage parents to spend any of their money currently and put money directly into their child's supplemental needs trust. A couple other things that are very important with supplemental needs trust are whether they are third-party trusts or first-party trust. And the differentiation is not in how they work, but whose money funds the trust. So in a third-party trust, which hopefully most of them will be, the trust is funded by anyone's money or assets or property other than assets or property of the disabled person. On the other hand, a first-party trust is funded exclusively with monies that belong to the disabled person. So you may ask, well, how is a disabled person going to come into money? Well, they might be working, earning money. Maybe not enough money in total to support themselves, but they're earning money. Maybe on a winter's day, they slip and fall outside of CVS, and CVS was negligent and didn't salt their sidewalks. And it results in a personal injury lawsuit, and they have money coming to them. Not something you can plan for necessarily, but it happens. Or maybe when you went down to create your supplemental needs trust and the attorney said, you know, make sure you talk to your extended family, you forgot about Uncle Joe. He was the guy who had, it's only Uncle Joe. He doesn't have much. There's no way he would be contributing to our child's supplemental needs trust. But unbeknownst to you, Uncle Joe made your son or daughter a beneficiary of his $50,000 life insurance policy. And upon Uncle Joe's death, guess what? Your son or daughter just came into 50 grand, which can upset benefit eligibility. So many times when that happens, either as a result of things that could never have been planned for or poor planning in general, the disabled beneficiary comes into his or her own funds, and the law allows for that person to create a first-party supplemental needs trust, which functions just like a third party with the one exception, and that is in a first-party trust, upon the death of the beneficiary, the disabled individual, that too comes with a Medicaid payback provision. Medicaid gets to be reimbursed by the first-party trust to the extent there is money left in the trust for the care they've provided, the benefits they've provided that disabled individual. A third-party trust, on the other hand, And again, examples like the one my wife and I have in our wills, all ready to go for our son. We as creators get to say in the trust document, oh, when Craig is no longer here, whatever money is left in the trust, this is how we'd like it distributed. To whom, or to an institution or a charity, or whatever the case may be. We control who ultimately gets the money. So proper planning with trust, and again, there are some things that happen during someone's life that you never expected. It wasn't something you could plan for. And people will come into money by accidents or lawsuits or whatever the case may be. But the Uncle Joe stories is the ones that you want to try to avoid. So again, testamentary trust or living trust, first party trust funded with disabled person's money, third party supplemental needs trust funded with everyone else's money, anybody else's money rather. And making sure you understand that once the trust is operational, the trust is irrevocable. Money goes in, it can only come out to benefit the beneficiary. Okay, now we can move on back to where we started with guardianship. There we go. Okay. All right, quickly a word on guardianship, and those of you who have children over the age of 18 who have already gotten guardianship, you can take a short break here. But guardianship simply involves this. In the state of New York, and in most states actually, but in the state of New York says that a person under the age of 18 is incompetent. A person under the age of 18 cannot make proper decisions for themselves. That's why they have parents or guardians. And so by default, we as parents are guardians of our minor children. When one makes a will, executes a will, one of the first things an attorney will ask is, who do you want to name as guardian for your minor children, those children under age 18? And typically in a typical husband and wife or married couple environment, it's the other spouse. My wife, I've named my wife has named me. But at age 18, the state of New York flips the switch and says, once they're 18, they're perfectly capable of making any and all decisions on their own. Those would include financial decisions. They can enter into financial contracts. They can decide the proper medical care they might require for health needs, et cetera, et cetera, et cetera. Well, I can tell you honestly that my son, Craig, he understands money. He knows he needs some to go to the store and buy stuff that he wants to buy. $100, $1,000, $1 million makes no, he doesn't understand that concept. Can't make change. He takes $5 to the store and buys a CD, and it's a cheap CD and it's $4.28. He doesn't know how much change he's supposed to get. Craig had open heart surgery when he was 7 weeks old. Fortunately, it went very well. He's still here at age 32 and doing great. But if that situation arose today, he couldn't make that decision. He couldn't make that call for himself. So the alternative, one of the alternatives at age 18 is to pursue guardianship. And in the state of New York, and again, I'm using a legal term, and again, I have to say I'm not an attorney, is something called a 17-A, A as an atom, guardianship. And that's it's called a plenary, Plenary, guardianship, whereby an individual with a disability which came about prior to age 22, looks like it will be lifelong, and prohibit the person from caring for themselves or supporting themselves financially, is eligible for guardianship, this type of guardianship. You really don't need an attorney in this process. You will need ultimately 2 professional affidavits from a physician who's had a history with your child and a psychologist, not a school psychologist, but another, practicing psychologist. Absent a psychologist, if you have more than one physician who has history with your child, they'll take those affidavits from 2 physicians. But the affidavits are basically the professionals attesting to the fact that based on their knowledge of the individual and history with the individual, They are attesting to the fact that, in their opinion, that this individual will never be able to make proper decisions for himself, etc. And so this goes to the surrogate court in the county where you reside, be it Albany, Schenectady, Rensselaer, wherever. Again, there's a bunch of forms and paperwork that have to be completed by the people who are petitioning for guardianship, typically a mom and dad or a couple. When we went through the process, we started about 8 months prior to Craig's 18th birthday. Judges are sometimes reluctant. Could you petition it at age 14, hypothetically? But yeah, you could, but you're already the guardian because the person is a minor. And judges are sometimes reluctant, and every county's judges are different, family court judges, surrogate court judges, I should say, I'm sorry, to take away someone's rights too early, because they're, well, will the person develop? How much will they grow? Sometimes, in our case, as an example, Craig has Down syndrome, as I've mentioned. It took us 35 seconds, literally, to determine this was the right path. On the other hand, someone with epilepsy, someone particularly with autism, falls somewhere on the autism spectrum. Is it the right move? Could the individual, make some of the right decisions? Maybe, maybe not. So absent going the guardianship fork in the road, if you will, the other fork in the road is to have the disabled individual execute their own power of attorney in their own healthcare proxy. They can appoint you as an agent. They could appoint someone else as an agent. Maybe right now they would appoint you, but as they grow and develop a little bit, they're out in the community, they're running with a circle of other people, some of whom may not be entirely honorable, who might be ready to take advantage of your son or daughter. Hey, why don't you let me be your power of attorney? I'll look after you. And then all of a sudden they empty the bank account. So these are things you just have to be aware of. Is there a right and a wrong here? Not really. Guardianship is more guaranteed, if you will. But again, sometimes it's an easy decision for folks to make, sometimes it's not. Okay, next. All right, someone asked a question, letter of intent, earlier. So this is the part of the show, if you will, where we talk about letter of intents. Very important. Letters of intent are very important. First of all, as the slide says here, you can see it's not a legal document. So it's not drafted by an attorney, but it's considered by the court. And what the letter of intent does is describe the disabled person's current situation as well as his or her hopes and dreams. And most importantly, is updated regularly. If I were to show you Craig's letter of intent, it would include such things as basic things that you would probably expect to find. Who's his primary care physician? Who's his cardiologist? Who's his day program provider? He has community have now. So who does he have that with? And contact information. These are the medications he takes, and these are the reasons he takes them. Basic stuff. And those medications in our case can change, and anybody's medications can change. The person he does community have with today might not be the same person 3 months from now, so those things need to be updated. But more importantly is what Craig would like to do with his life. If you asked him, he would tell you, I'd like to live in my own apartment. Now, honestly, do I see that ever happening? I have to be honest and say no, but I hope I'm wrong. I'm not giving up on him. But if I wouldn't put money on it right at the moment, would I like him to be in a less supervised type of residence? Yes, I would, as my wife would. And we do think that's potentially possible at some point. That's why we have these crazy ISP meetings every year. I'm sorry if I shouldn't be that political about stuff like that, but it's a necessary meeting. It's important to review goals and standards and whatever, but these are the things the letter of intent says. So I'll tell you again another quick story. When Craig was had to go to the intake interview to go into the group home 4+ years ago, the agency sent me an email and said, it's gonna take about 2 or 3 hours. Well, actually, they called me on the phone. It's gonna take about 2 or 3 hours. And I said, no, it's not. She said, well, we have to ask that. I said, no, it's not. I said, if you'll allocate an hour, that's all we'll need. No, it generally, I said, no, it won't. See, what they didn't know was we were going to show up at the meeting with Craig's letter of intent. So we did, 3 copies. So the meeting starts after the introductions and they start out, well, what is Craig? I said, it's in there. So every question they asked, and there were many, we said, that's why we have this document. All the information we think you need is in this document. And they said, we've never seen one of these before. I said, well, there's a first time for everything. But at the same time, my wife and I said, but understand something. If you don't share this with the house staff, it's worthless. If you just put it in a file here in the main office, it doesn't do anybody any good. And my wife and I will continue to update this annually at the very least. And we've held pretty true to that. And sometimes it's more frequently than that as stuff really comes up and changes. So this is something you can, I have a template I can share with you if any of you, we end up following up with one another. And again, it's just that, it's a template. It's not anything structured. One of my clients, her son's name is Jeremy, and she has a spiral notebook. She calls it Jeremy's Bible, but that's her letter of intent for her son. But these are very important things because otherwise it tells a story at a moment in time, most importantly of not only what is the current situation, but what are we hoping it can become down the road and what's needed to potentially get there. So again, I encourage you to do that. And if you ever become a client, and those of you who become a client of mine, I do stay on top of clients to do this. I meet with clients typically twice a year. And if you haven't done a letter of intent, I'll look at my notes. And the last time we met 6 months ago, you told me you were going to do it. So that's the first thing I'm going to ask to see. Show me your letter of intent. So if you don't want to be reminded of stuff, maybe I'm not your guy. But my job is to try to keep everybody, moving towards the same target. And again, I strongly encourage a letter of intent. So okay, we can go next here, Erica.
And Bill, just so you know, it's a couple minutes after 7:30.
Yeah, I know, I can see that.
Okay.
So as I said at the outset of the meeting, I'd like to help. I think one of the things Erica distributed before this meeting, at least I think she did, was like a 1-page checklist, 10 or so questions on it. I hope you've had the time to answer those. I know we're running a little bit over, but as I mentioned, I'm going to give everyone who's on the meeting tonight the opportunity to reach back out to me and request a follow-up discussion. I'd be remiss if I didn't tell you how I'm compensated. In 25 years, I haven't charged people with this type of planning a fee. And the reason I don't charge a fee is because this is my passion. This is what I do. I think in some ways I become also an advocate for your child. I've had to nudge parents, some stronger than others, to get the legal work done. Some parents it's taken only months, some people it's taken years. And lawyers are going to charge you a fee by the hour because that's That's their method of compensation. Me, on the other hand, I try to understand your situation. I try to understand the goals you want to try to accomplish for your son or daughter, as well as yourself. And then in the course of the work I do, I may come back to you with recommendations for various insurance, annuity, or investment products. And if you think they make sense and fit into your overall plan, or those that do, then I'm compensated by the companies whose products we ultimately implement. So again, I look forward, hopefully, to seeing some of you in person in the not too distant future. Those of you who may want to follow up with me, if you give Erica your permission, she will share your email and your contact information with me, and I will get in touch with you fairly quickly. But again, as I said, the time to plan is not in a few months, in a few years. It was yesterday. Today's almost done. It's 7:36 by my clock. And so tomorrow would be a great day. So again, I thank you for taking the time. I threw a lot of things at you, a lot of information. I promised I would stay for questions. I'm going to leave, and I will. I'm going to leave that up to Erica. But seeing no questions, I hope this has been helpful. I hope to see some of you in the not too distant future. Those of you who may not be ready to commit to having a follow-up conversation now, Erica has my contact information. Feel free a month from now, a year from now, if you want to reach back out, that's perfectly fine. So again, my thanks. I thank Erica and the Epilepsy Foundation for giving me the opportunity to quasi be in front of you. I hope this has been helpful. Thanks so much.
And Bill, we actually do have one quick question for those who want to stick around for the answer that is general for everybody. The question was, can you decline a beneficiary benefit from Uncle Joe?
Not if it's in the form of a beneficiary designation. Give you an example. If Uncle Joe left you his house, Uncle Joe's single, it's just Uncle Joe, okay? That you can decline. But if you think about a benefit, I mean, and if you're the only beneficiary, I should preface that by saying, if you're the only beneficiary on Uncle Joe's life insurance policy, the insurance company can't keep the money. They have to pay it to somebody. So those are very, very, maybe there's a legal way to do it. If there is, I'm not aware of one. But other types of real property, yeah, I mean, you know, I'll give you an example. My wife owns her family home that she grew up in upstate New York. And I told her when we redid the wills, I said, don't leave it to me. It really should go with someone in your family, ultimately. Unfortunately, she's one of the younger people in her family at this point. But you know, I said, it doesn't hold the sentimental value to me that it would have to somebody who lives 120 miles north of where I live here in Niskayuna. So those kinds of things, it's easier to just say thanks, but no thanks to. But a monetary beneficiary designation, when you're the only beneficiary, that's a tad harder. And I know that probably doesn't answer the question completely, but that's the best answer I can give at this point.
Okay. And someone else asked, can you briefly review the OPWDD service? Does it affect the trust?
I'd have to know what OPWDD service means.
Right, which one? Let's see.
All right, let me answer it this way.
Self-direction.
I use my son as an example, okay? He lives in a group home. He has a trust. Now, it's not funded. It's not a living trust, but he will have one at some point in the future. The trust has been crafted by an attorney whose reputation is impeccable. I know the attorney does this type of work on a regular basis. I have no qualms at all about the trust being legitimate, none. In every case, a good portion of the funding of the trust is coming from life insurance by design. Part of the funding for the trust ultimately will be from residual value of a portion of our estates. How much that will be, don't know. Can't tell you yet. All right. But it will go not directly to Craig, it will go to Craig's trust. So he can enjoy the benefits of having this extra monies that he could have spent for his special needs as they arise. It's not going to invalidate his eligibility for government benefits, Medicaid. And since his house is funded by Medicaid, his day program is funded by Medicaid, his community hab is funded by Medicaid, his health insurance is Medicaid. It's not going to, based on current law, it's not going to impact that. So I don't know if that answers the person's question. But if the trust is designed properly and funded properly, and really funding doesn't come into it at all, as it relates to services, the individual beneficiary, my son Craig, doesn't own anything in the trust. It's owned by the trust, which right now is zero, but ultimately, obviously, there'll be money in there. And that will not create and affect his eligibility for any type of services from OPWDD. There's been court cases, countless court cases over the years that would document that. So I hope that answers the person's question. But that's my reply to that.
Thank you. And if anyone has any questions that come up after this evening, you're all going to have an email in your inbox from me tomorrow at some point during the day. So please feel free to shoot an email to me. Please feel free to send me that form that I sent out completed, and I can pass on your information to Bill so that he knows that you're interested in having him reach out for that follow-up meeting. And just to echo what Bill said, we really appreciate you coming out tonight and spending the evening with us. And I hope you all have a good weekend. Thanks so much for being here.
Likewise, enjoy the rest of fall. Hopefully it stays as nice as it was today.
Yes, definitely. Have a great night, everybody.
Bye-bye.